of the semester. Looking forward to it. Alex, you're going to be our first presenter. We are live on YouTube right now, and we're going to be joined with people who are viewing, and they'll be asking questions. We look forward to your questions. Alex, floor is yours.
Good morning, everybody. My name is Alex Penkwitz, and I'm a junior in the AIM program covering the international technology, information technology sector. And today I will be pitching OpenText Corporation, ticker OTEX. OpenText Corporation is Canada's largest software company, operating as a provider of enterprise information management software and solutions. OpenText has four primary business segments: customer support, cloud services and subscriptions, license, and professional service and other. OpenText generates a majority of its revenue from the Americas, followed by Europe, Middle East, and Africa as one region, representing 33% of their revenues, and Asia Pacific, representing 10%. OpenText currently has 12,000 employees that address a diverse global customer base consisting of nearly 10,000 organizations, with no single customer accounting for more than 10% of total revenue. OpenText Corporation was founded in 1991 and is headquartered in Waterloo, Ontario, Canada. On to my recommendation. OpenText Corporation completed their IPO in 1996 and has developed into a dominating force in the software industry. The company has experienced a 5-year sales CAGR of 12%, an operating income CAGR of 10%, and has maintained operating margins between 18% and 23%. During the same time period, OpenText has completed 13 successful acquisitions, focusing the inorganic growth on their cloud services segment. This strategy has continued into fiscal year 2019, driven by two of the company's most recent acquisitions, Catalyst and Liaison, which both operate in the cloud storage space. Management focuses their efforts on driving growth through the cloud services and subscription segment while maintaining stable revenue growth in the other three segments. Annual recurring revenue, which is composed of cloud services and subscription revenue, increased 3% year over year, representing 73% of fiscal year 18 total revenue. In the second quarter of 2019 alone, the license segment captured 19 deals, which increased 3% from last year, each valued over $1 million, followed by the cloud services and subscription segment, which with 16 deals valued over $1 million each. OpenText looks to create next generation EIM solutions through strategic partnerships with companies such as SAP, Microsoft, Oracle, and Salesforce.com. With cloud-based systems increasing in demand, a strong acquisition strategy, and growth opportunities within the EIM software market, it is recommended that OpenText Corporation be added to the AIM Equity Fund with a price target of $44.81, representing a potential upside of 21.02%. Now on to my investment thesis. OpenText Cloud Expansion. According to Markets and Markets, the cloud storage market is estimated to increase to $88.91 billion by 2022, driven by the adoption of hybrid cloud storage, the need for improved efficiency, and growth in the Internet of Things. With OpenText's new diversified platform, sharing this expanding market can be taken through the company's cloud. OpenText Cloud is less than 20% penetrated within the company's current installed customer base. OpenText is scaling to a $1 billion year run rate in the cloud as more customers begin to move towards a cloud-based system. Currently, over a third of their pipeline today comes from this segment. In addition, recent partnerships with Google Cloud Platform, Amazon AWS, and Microsoft Azure provide growth opportunities for OpenText in these previously untapped markets. Strong acquisition strategy. Part of OpenText's business system designed to create value is through the acquisition and integration of companies. In the last 60 days, OpenText invested $380 million of capital to acquire two companies, Catalyst Repository Systems, who is a lender of e-discovery solutions, and Liaison Technologies Incorporated, a leading provider of cloud-based enterprise information application. Management expects these acquisitions to contribute a total of $55 million toward cloud revenue in the second half of 2019. In addition, this entry into Europe gives a growth opportunity for OpenText to expand its global footprint. The ability to selectively pursue acquisitions allows OpenText to expand business-to-business capabilities, as well as their market of application-to-application integration as newly deployed cloud applications develop. OpenText currently has $1.1 billion available in liquidity and has stated that they plan to be more aggressive in their acquisition strategy for the remainder of 2019 and into 2020. It can be expected to see more synergies from acquisitions similar to the ones seen in the beginning of 2019 for the years to come. EIM software market. In OpenText's most recent earnings call, the company stated that there is currently a $100 billion addressable market for EIM software. OpenText plans to capture this growth opportunity through M&A organic growth, distribution expansion, and strategic and disciplined capital allocation. The company has announced that within the next 5 years, they will be investing $2 billion in organic R&D for EIM to advance their technology for this market. On to my valuation. In order to reach an intrinsic value for OpenText, a 5-year DCF model was constructed. Using a terminal growth rate of 2% and a WACC of 7.43%, an intrinsic value of $44.21 was reached. A sensitivity analysis on the terminal growth rate and WACC ranged from $36.20 to $55.92. Additionally, a PE multiple valuation was calculated. Using a 2019 estimated EPS of $1.30 and utilizing a blended weighted average PE multiple of 27.56 times resulted in an intrinsic value of $35.83. Finally, an EV to EBITDA multiple calculation was calculated using a blended weighted average EV to EBITDA multiple of 13.41 times, resulting in an intrinsic value of $55.61. By weighing the three models 60, 20, 20, a price target of $44.81 was reached, resulting in a 21.02% upside. OpenText pays an annual dividend yielding 1.6%. On to my risks. Quarterly volatility in the license segment. OpenText experienced quarterly volatility related to sales in its license segment. This results from the company's transition to a mixed traditional/subscription-based business model. If OpenText is unable to secure recurring revenues from other segments to help provide stability, the company may see continued volatility in the license segment. Length of sales cycle. The implementation of OpenText software or services often involves a comprehensive process across the customer's network. This may result in a significant commitment of resources by prospective customers in order to become fully integrated. Given the sizable investment, the sales cycle may be longer compared to other companies in the industry, which may decrease OpenText revenues. Compatibility. As technology advances, OpenText software must remain compatible with standard platforms and file formats in order to remain attractive to customers. If they are unable to achieve this, the company may struggle to gain new customers. And to touch on management, Mark J. Baranachia joined OpenText as President and Chief Executive Officer in January 2012. In 2016, Mr. Baranachia also took on the role of CTO, followed by being appointed as Vice Chair of the Board in 2017. Before OpenText, Mr. Baranachia was the CEO of Silicon Graphics International Corporation, as well as CTO for CA Inc. I would like to now open the floor.
All right, Alex, thank you. Let's start with Eric.
So in 2019, your revenue grows by roughly 4%, your operating income by 20%, and then your EPS jumps by 43%. Can you comment on that?
Yeah, so to comment, just,
Yeah, good.
oh, sorry, yeah, so
Summarize
the question was in regards to a lot of things, but where do you want me to start with the revenue?
So the revenue's grown by 4%, then operating income by a lot more, and then EPS by even more than that.
Yeah, so to comment on the revenue increase of only 4% with the operating margin increase, correct? So in Q1 of fiscal year 19, they had kind of a down quarter and they missed revenues, but they bounced back in quarter 2 with record revenues and margins. And for the remainder of 19, I projected out slow growth because I wasn't comfortable projecting out like a big boost in their revenues for the rest of the year. And as for the operating margins, in 2019, they began to shift towards cloud, which is basically their second largest, it is their segment with the second largest margins. So if you think about it as you have a greater percentage of your revenues generated from a segment with higher margins, you can have a decrease year over year in operating margin, but an increase in operating margin percent. That answers your question. And then do you want me to comment on the EPS as well?
If you want me.
Yeah, so, sorry. So to comment on the EPS in 2017 to 2018?
No, 2018 to 2019, it jumps by 43%.
Yeah, so, and I want to comment on 2017 as well. So in 2017, you can see that the EPS is 4.16, and this is because in 2017, they had a tax provision of 766 million. So that number is kind of misleading. But in 2016, they had an EPS of 1.17, and then it jumps to 4.16 in 2017 just because of the tax provision. Then it kind of normalizes out to 2018. And then in 2019, I just have it growing just because I feel like that's the normal rate of growth that it's going to be growing after the future. So that answers your question.
Yeah.
So I've got a couple, we'll start top down. WACC greater than ROIC, if you can touch on that. Your recurring revenues are 73%. As they move towards the cloud and more subscription revenue, do you see that recurring revenue number growing? What is the company going to put out on that? And also, could you touch on the run rate in the first round.
Okay, so there's 3 questions. The first one is with the ROIC less than WACC. So I did a little digging into that, and I couldn't find an exact answer. But in 2018, their return earnings and total stockholders' equity doubled, and I think that might be in part of 20 million shares were reissued, or 20 million more shares were issued in 2018. So that might have had a little bit of a factor on the dip in the ROIC. But if you look historically, their ROIC floats around 8%. So I don't think that's really an issue going into the future. And then the second question was related to the recurring revenues. Yeah, so their cloud segment is really high on the recurring revenues, just because when OpenText goes into your company and integrates everything, it's really expensive to switch off of it, just because of the time consumability of going in there and actually making everything compatible to one large cloud and source. So the recurring revenues have actually increased because people are starting to realize that. And as their technology increases in like their efficiencies, there's no real reason for them to switch off it. So they've been generating higher recurring revenues in each year.
So you do see that maybe growing going forward?
Yeah. So I think last year, I think it said it was 3%, and that was, I think, their highest year-over-year percentage so far. And then what was the last question?
The run rate in the first driver.
Yeah, so the run rate basically means that their current financial position is going to continue into the future. So their run rate is going to be $1 billion, which means that they're just projected to quarterly gain to $1 billion in that year.
Thank you. Okay, Gino.
Just touching on your peer valuation a little bit, how did you get your competitors? It seems kind of a wide spread from IBM all the way to SBS College.
Yeah, so it was kind of, I wanted to choose comps that had a lot to do with the cloud segment. And so I chose IBM because they're a major player in the cloud space, but I just decided to weight them less just because of the pure size compared to OpenText. J2 Global is also a player in the cloud space, and I just decided to weight them a larger weighting of 20% just because of the closer size in relation to OTEX than it was for IBM. SPSC, similar situation to J2 Global. They're gaining they're primarily in the cloud space, but I was comfortable giving their higher weight just because I wanted to better reflect their primarily cloud-based services. SYMC, this is actually their closest competitor to OTEX, so I give them the highest weighting just because of their size, the closest one to OpenText. And Adobe, similar situation to IBM. They conduct cloud-based solutions through the digital media segment, and I gave them a little bit as well.
And then secondly, just on 2026 revenue, how did you arrive at that number? How did you get that 12.8% growth?
Yeah, so as I stated earlier, their revenue in 2019 was slowed. So I projected out that they would stably grow in 2020 to what they had originally. So although it only grew at 12.8%, it's still normalized to what they have been doing rather than the 3.66.
Do you know what your growth is in 2021 and 2022?
I do not. I think I have it at about 14%.
Okay.
I don't have the exact number, but I can follow up.
Okay. Thanks.
Andy?
Yeah, in regards to your driver of the EIM software market,
Yep.
You say there's a $100 billion addressable market. Do you know approximately what their market share is in that? And like, are they the number one, or do they have like competitors that have more market share?
It's hard to measure their market share in the cloud segment or in the cloud market as it is, just because the cloud's so hard to measure as itself. So I don't have an exact number. I can follow up with you after and try to figure it out.
Who else? Questions? Anyone else? Bill, any follow-up?
How much of their revenues come from subscription versus license?
I do not have the exact number up with me.
Have you looked at a cell yet?
I have not. No.
Okay. Want to wrap up? What final recommendation?
Yeah, so,
key driver to watch.
What I would say, I think, as most of you can tell, that I'm pretty based off of the cloud initiative, and as more companies shift towards the cloud, I think OpenText has a great opportunity to capture market share and increase their revenues.
All right. Thank you, Alex. All right. Sean? All set?
All set.
Didn't wear your army fatigues today?
No, I did not. I didn't even have to work this morning, so. All right, good morning. My name is Sean Halverson.
Could be.
I am a junior in the AIM program covering domestic industrials. The company I'm pitching today is Vicor Corporation, ticker VICR. Vicor Corporation is a designer of components and power systems that are built to convert, regulate, and control electric currents. The company generates revenue through 3 business segments. Their brick business unit segment is responsible for developing and manufacturing the company's legacy products. Examples include DC to DC converters, AC line rectification, input filtering, and power factor correction. The VI chip segment produces the company's advanced set of power component products that are used in autonomous vehicles, aerospace and aviation, and supercomputers. The P-Core segment is used as a complement to the VBU and VI chip segments. It is integrated to help create more value in their supercomputer efforts, and Vicor sees revenues both domestically and internationally. The company was founded in 1981 and is headquartered in Andover, Massachusetts. So essentially what Vicor is doing is providing value for companies by increasing processing capability and giving companies the ability to operate at a more efficient rate within their data centers. Moving on to my recommendation. With the rising need for rapid, efficient processing capabilities, data centers can no longer rely on 12-volt systems because of the size and weight, low processing capabilities, and costs associated with maintaining their operations. Technology giants like Google and NVIDIA, who are consistently managing immense amounts of data, are already moving away from 12-volt to 48-volt systems. Vicor enables companies like NVIDIA the ability to convert power in their data centers at a 48-volt system that provides a more direct and efficient source of power. The company feels that they are the market leader within the technology and serve as a disruptor to the computing market. Over the past decade, Vicor has spent $400 million in patents in developing their technology to protect their converters that convert traditional 12-volt to a leaner yet stronger 48-volt system. Based on the following, it is recommended that Vicor Corporation be added to the AIM Equity Fund with a price target of $45.10, representing a 19.42% upside. Now on to my drivers. The data center supercomputer environment is evolving. Since 2012, the amount of computing within AI processing has been doubling every 3.5 months. In order to sustain such exponential increases, Vicor released their non-isolated bus converter module and power-on package solution that are built to convert a traditional 12-volt infrastructure to a stronger 48-volt design. According to Vicor, this new design is giving data centers a 16 times reduction in power loss and a 4 times reduction in capacitor volume. This technology is being used in NVIDIA GGX2, which was renowned as the world's most powerful AI system. Because of the integration of Vicor's POP and ZBS buck regulator and supercomputers like the VGX2, they are experiencing a rapidly growing backlog. Additionally, in order to fulfill that backlog, they actually have a capacity to grow. So at the conclusion of 2019, Vicor will have completed a major expansion to their facility in Massachusetts. The expansion is in response to the long-term capacity requirements for the growing demand within their advanced products. With the extra 90,000 feet being added on, the company will be able to shorten lead times and, in the short term, increase revenue and total capacity by upwards of 50%. Additionally, Vicor has started to become an autonomous technology leader. With Vicor's 48 power design within their product, the Power Strip, driverless vehicles and mild hybrids can expect a longer life in their batteries and increase fuel efficiency by upwards of 10%. For the sake of time, I'm going to skip my evaluation and save that for any Q&A. Moving on to my risks. Capacity constraints on advanced products. With the spike in demand of 2017 in advanced products, Vicor did see some challenges with filling their backlog due to current capacity constraints. The company was not able to quickly fulfill customer needs and led to a negative operating income. Furthermore, Vicor does experience some exposure to Chinese markets. Since this is industrial tech, it does see significant revenue from China and is open to the risk of operating with their customers. The company is also looking to open a facility in the area and could experience developing issues with the current China trade dispute. At this time, I'd like to open the floor to questions.
Nick, you want to start?
Yeah, so let's go to the valuation.
Sure.
So 2 of your methods give us indicate to us that that it's overpriced, right? So, and if you were to take out monolithic power systems, it would be even more overpriced. And the only reason that we're getting an upside is because 70% is coming from a 7-year DCF. So, which is actually pretty sensitive. So can you walk us through your valuation? And also it seems that it's hard to estimate the income statement because historically their net income has been pretty volatile. So can you kind of walk us through how you forecasted it and
Sure. So the reason why I weighted my DCF at 70% was because I wanted to see the full effect of the expansion that they're putting on the facility. And additionally, I did not feel strong in the comp group because there's not a lot of companies that are involved in this technology. I mean, it's hard to compete with a $400 million patent at stake. So that's a pretty significant economic moat. And I feel that the DCF is the main driver behind my model, and this capacity to grow will help fill those needs.
So can you, like, your revenue growth, can you, like, so out 7 years, kind of like, what's the trend look like there?
Yeah, sure. So I have revenue in 2021 going up 20%, 15%, 2022, 23, and then it gets down to 10% in 2025 and 2026.
Eric?
So your second driver, you mentioned in the short-term revenues and capacity will have the potential to increase by up to 50%.
Yeah.
Are you saying that revenues could increase 50%? Because that doesn't really make sense to me, because just because I build a big factory doesn't mean it's going to be utilized. So
Yeah, so no, the capacity of the facility will be increased by 50%, which gives revenues and upwards of 50%, but I took a more conservative estimate inside my DCF. But they're utilizing this facility to help fill that backlog, which is going to give them more capabilities and resources to manufacture their products more efficiently.
Eric?
Just one more thing real quick. Did management put out like an EPS guidance for 2018?
No, they did not. I cannot find it.
So if the US-China trade deal goes south, how is it going to affect the company? What are they going to do about it?
So at this time, you know, management does recognize the fact that they are trying to open a facility, work with customers within Asia, but they currently, I believe what they saw in October was that in fact they stock took a little bit of a hit, but they did have a little bit of a rebound at the end of 2018. So I think as time goes on, they'll be able to work through those issues.
You kind of just touched on my question, but high-low is 1664.
Mhm.
Like, in the last 52 weeks, can you just talk about that? Why it's
So yeah, so the company has been a little volatile in the past, but once the facility gets expanded, they have more capacity. The demand is there, so I believe, you know, it's been quite. There's been a large bound between the two.
Bill, how do your estimates relate to consensus estimates?
Oh, so yes, thank you. So the management does give a short-term goal of getting gross margins up to 60%, operating expenses down to 30%, which will give you an operating income of 30%. So that's why if you can see in the data box percent growth of operating margin, getting up towards that 30% in 2020.
How many analysts cover the stock?
Currently, there are no analysts that cover the stock, so the research was done based on my assumptions and research.
So we did get an email in from someone, again, part and parcel with what Bill asked, that really strong operating growth margin that you have. One more time.
Sure.
That's
So
a key assumption in your model.
So the reason for this growth of operating income is because this gross margin increased from 2018 to 2019 of about 11% from 48 to 59. And R&D is supposed to gradually decline, and additionally SG&A is going to remain stable. And with this expansion of the new facility, that they really believe that the management believes that gross margins will get to that 60% threshold. Additionally, operating expenses will get down at 30% of total revenue, which will give us that operating margin around 30%, 33%.
Okay. Yeah.
What's your short interest?
10.5%.
Yes.
So I don't know if I understand this company too well, but can you just mention like fixed costs and what are kind of just like goes into the cost of goods sold, or is that not really like an issue?
So in 2017, the operating income was due to that backlog. So I believe some of that was due to the cost of goods sold being a little bit higher and having to take on additional equipment in order to produce those products. But in 2019, 2020, more likely 2020 with this expansion new facility, they'll help bring down those cost of goods sold, and build a more efficient model for them.
Is raw materials like an aspect?
Yes, that's raw materials are.
Like what kind?
You know, for converters, you're taking on like metal, aluminum, stuff like that, in order to put into like supercomputers.
We'll do two really quick ones here. Edward?
What's your country of spirit?
I did not use country spirit.
How much in the space of autonomous vehicles are there?
They said management discussed that they are gradually increasing their outlook into autonomous vehicles, but at this time, I believe it's slowly growing.
Good. Anyone else? Bill, last one.
How much of their business is related to artificial intelligence? Or what product are they selling into that is used for?
Oh, okay, thank you. Yeah. So I believe they're about 65% of the company is dedicated to artificial intelligence, but it's more their converters are used within the supercomputers that produce the artificial intelligence.
That's your NVIDIA.
NVIDIA DGX2, yes, correct.
Okay, very good, Sean. Thank you. Next presenter, Derek. Got an event tomorrow?
No, I'm off this weekend.
Are you? Sleep in.
All right. Hello, everyone. My name is Derek Gross. I'm a junior in the AIM program covering domestic information technology. Today, I'll be pitching InterDigital Incorporated, ticker IDCC. InterDigital is a domestic developer of technologies that enhance and enable wireless communications. The company continues to lead in developing technologies relating to 3G, 4G, LTE, 5G, and the Internet of Things. Through its vast portfolio of over 38,000 patents, InterDigital earns revenues from leading companies within the telecommunications industry. Although based domestically, InterDigital earns only 36% of revenue from the United States, followed by 21% from South Korea and 14% from both China and Canada. InterDigital earns the majority of revenue from fixed fee royalties of 56%, followed by passive patent royalties of 31%, per unit royalties of 9%, and technology solutions of 4%. InterDigital was founded in 1972 and is headquartered in Wilmington, Delaware. Now moving on to my recommendation. Recognized as a top 100 global innovator by Thomson Reuters, InterDigital is a leader in the development of and licensing of standard essential patents, also known as SEPs, and wireless communications, and is well positioned to capitalize on emerging trends within the industry. Over the past 5 years, the company has experienced a 10.3% sales CAGR, a 28.8% operating income CAGR, and a 36.7% net income CAGR. In the past 2 years, InterDigital has acquired Hillcrest Laboratories to expand their total addressable market to include the Internet of Things, and has acquired Technicolor SA to expand reach within consumer home electronics and video. Management expects immediate contribution from Technicolor with a 10% increase to the total addressable market and revenues, while Internet of Things will be slower to materialize but presents a considerable growth opportunity. With a 5-year CAGR of 38% for non-smartphone devices and a total connected devices market of over $62 billion by 2022. InterDigital plans to leverage their advancements within 5G, Internet of Things, and video paired with established SEPs in 3G, 4G, and LTE to win new contracts with some of the industry's largest original equipment manufacturers who remain unlicensed. With an IP portfolio of over 38,000 patents, InterDigital possesses roughly 7 to 10% of SEPs necessary for smartphone manufacture. Any company utilizing 3G, 4G, or LTE is subject to negotiate with InterDigital to determine royalty rates. Additionally, the recent trade negotiations between the United States and China have given hope to a deal that would strengthen IP enforcement overseas and stop government-sponsored cyber theft, which would be a huge win for the company. Given InterDigital's efforts in 5G and Internet of Things development, expanded reach, strategic acquisitions, and competitive advantage in holding essential patents, it is recommended that InterDigital be added to the AIM equity portfolio with a price target of $98.54, presenting a 34.50% upside. Now moving on to my drivers. Firstly, unlicensed OEMs. Although InterDigital currently has contracts representing over 38% of global smartphone OEM market share, nearly 46% of the market still remain without license. These include Chinese manufacturers Huawei, Oppo, Vivo, Xiaomi, and Lenovo. Any manufacturer who sells devices utilizing 3G or 4G is subject to InterDigital patents, and OEMs looking to expand growth overseas will be forced to negotiate fair, reasonable, and non-discriminatory, also known as FRAND, royalty rates. Huawei's contract with InterDigital expired at the end of 2018. The company recently filed a civil complaint asking Chinese courts to set a FRAND royalty rate for the company to return as a customer in the near future. Adding Huawei back as a customer would add over $75 million to recurring revenues, boost net income by roughly 22.2% annually, and raise the intrinsic value of the stock by 9.2%. Additionally, any trade deal between the US and China that enforces foreign recognition of IP would be a huge win in negotiations with Chinese owners. Secondly, the Technicolor acquisition. In September 2018, InterDigital closed on the purchase of Technicolor SA, adding over 18,000 patents to nearly double the existing IP portfolio. This acquisition is expected to expand total addressable market by over 10% by increasing patent license opportunities in video services and consumer electronics. Television and video and virtual reality, two areas which Technicolor holds essential patents, represented a market of over $265 billion in 2018. Management expects the Technicolor acquisition to provide a 10% bump to current recurring royalty revenues and to increase long-term profitability by 50% after absorbing initial integration costs. Lastly, the future of 5G. InterDigital is a leader in the development of essential patents needed to support 5G connectivity, which is expected to debut in limited fashion in mid-2019 before becoming completely commercialized in 2020. Forecasts by rival patent developers predict 5G to grow its subscriber base to 1.5 billion by 2024 and cover approximately 40% of the global population. InterDigital ranks among the top 6 companies globally in standard essential patents related to 5G and ranks second in the United States. Samsung, InterDigital's largest customer, recently entered into agreements with AT&T and Verizon to manufacture 5G phones, and Apple plans to release a 5G model of the iPhone in 2020. InterDigital is positioned well to capitalize on this growth. Now on to my valuation. In order to reach an intrinsic value for InterDigital, a 5-year DCF model was constructed using a terminal growth rate of 2% and a WACC of 9.01%, an intrinsic value of $106.62 was reached. A sensitivity analysis on the terminal growth rate and WACC ranged from $83.54 to $163.64. Additionally, a P multiple valuation was calculated. Using a blended average P multiple of 22.8 times resulted in an intrinsic value of $75.60. An EV to EBITDA multiple calculation was conducted using a blended average EV to EBITDA multiple of 11.4 times, resulting in an intrinsic value of $110.50. By weighing the 3 models 40, 30, 30, a price target of $98.54 was reached, resulting in a 34.5 potential upside. InterDigital pays a dividend yielding 1.8%. Now moving on to my risks. First, customer concentration. InterDigital receives a large majority of its revenues through contracts with some of the industry's largest OEMs. Historically, InterDigital earns around 70% of revenues from companies that account for more than 10% of revenue individually. A loss of contract with one of these customers could cause a significant decrease in revenue. Secondly, enforcement of patents. Patent licensees, in most cases, do not actively seek to enter into license agreements before producing and manufacturing technology that contains the patents. InterDigital must identify companies and establish license agreements, many of whom are very reluctant to do so. Legal disputes over the use of patented technology could reduce company profitability. Lastly, slowing smartphone growth. The global market for smartphone sales seems to be maturing as companies such as Apple and Samsung have decreased revenue guidance. Smartphone penetration has plateaued, and slowing sales will affect the variable portion of InterDigital's royalties, which represented 9% of revenue in 2019. However, innovation related to 5G is expected to deliver renewed smartphone sales growth in the near future. And with that, I'd like to open it up to questions.
So between 2017 and 2018.
Yeah.
So I'm guessing you have 2018 as an estimate. I'm guessing that's because they haven't reported yet.
Yeah, so they actually report next Friday.
Okay. So and then it seems so the revenue growth number falls quite a bit. Operating income growth falls. Margin falls. Can you just kind of touch on what happened?
So yeah, so 2 things happened. The first was new accounting rule ASC 606, which limited the company's ability to recognize fixed fee royalties. Originally, they would recognize them when they signed contracts. So in 2018, we signed contracts with LG and Samsung. Now they'll have to recognize them over a straight line basis. Additionally, the rule prevented them from recognizing any revenue from Huawei during that.
Okay.
Yeah.
Nick here.
In your numbers for 2019 and 2020, are you projecting them to get Huawei back in those numbers?
No, I haven't included Huawei in those numbers. So the condition that I included in my unlicensed OEM drivers would bump the intrinsic value. Okay.
Elizabeth?
Could you just walk us through how you calculated your PPP valuation for that intrinsic value? I think your EPS would have to be like 350.
I believe I used trailing 12 months P. I got from
Why did you use an EBITDA multiple?
I thought it was just a good measure of the company relative to 10 years. It was slightly it was undervalued, so that was a good general way to relatively value the company.
Andy.
So you put in some numbers about what would happen if they got that Huawei back. What is the likelihood that they'll be able to, in your opinion, be able to add them back into there?
Sure. So another in 2013, similar situation happened with Huawei where they sued InterDigital saying that they were charging too much for royalties and they weren't fair. It was resolved in 2014. They returned as a customer. Even if they didn't, if they licensed any one of those other 4 OEMs, it would boost the intrinsic value by roughly the same. Oppo Vivo would boost intrinsic value by 8%, Xiaomi by 5.9%, and Lenovo by 3%.
It just seems like it's hard to model, but looking historically at the sales growth numbers. So I guess my question is, in those last 3 years that aren't included on here, just out of curiosity, what does it look like?
Yeah, so I 2021 I grew revenue by about 10%, and then 2022 and 2023 by about 4 to 5%. I did see more growth on my bottom line due to decreased patent administration and licensing and the fixed costs.
Anyone else? Bill? Yeah.
How much their opportunity going forward is just it's 5G?
I think that presents a huge opportunity going forward. I mean, all their contracts right now are 3G and 4G. And although AT&T and Verizon are debuting 5G in a limited fashion, they haven't officially launched any 5G models of smartphones yet. I know 5G is AT&T is marketing some of their phones as 5GE, but they haven't officially launched 5G commercially yet. So none of the revenue right now.
Very good. Thank you, Derek. Okay, presentation's very good. We're right on schedule. Matt, you're gonna bring us home here with a bang, huh?
Hello, I'm Matthew Prinske, and I'm a junior in the AIM program covering financial services. Today, I'll be pitching Sandy Spring Bancorp, ticker SASR. Sandy Springs is a small community bank operating in the greater Washington, D.C. area with headquarters in Olney, Maryland. The bank is a little over $8 billion in assets as a result of a $2 billion acquisition of assets closing January 1, 2018. Now I'm going to go right to my drivers. The Amazon Hq2 announcement. As a community bank, Sandy Spring is spurred by the growth of the region it operates in. As previously mentioned, Sandy Spring recently acquired Washington First Bankshares and retained many of their branches in Northern Virginia. I mention this because in November of 2018, a second headquarters for Amazon was announced in Arlington, Virginia, and they have since narrowed that down to the Crystal City area, a mere 10-minute drive from Capitol Hill. The headquarters is expected to add about 25,000 jobs into the area, which is more than the actual amount unemployed in the District of Columbia. It's also important to mention the immediate growth in the area. With legislation passed in Virginia, new jobs and infrastructure investments will begin over the next few years and continue for up to 10. Now, I'd like to spend some time on my next driver, as I know it might be a little odd. First, I would like to mention the fact that I use an excess equity model in calculating intrinsic value for the firm. In this model, equity available to shareholders is discounted at the cost of equity, making this calculation imperative to the model. As a quick reminder, CAPM equation is risk-free rate plus beta times an equity risk premium. I use an equity risk premium of 6.75 and a risk-free of 2.44 and calculated my own beta. The reported beta for SASR on Bloomberg is 0.89. However, I use a sector beta. By calculating 6 of my own betas and averaging them, I came up with 0.48. This was the beta used in the CAPM equation to give a cost of equity of 5.7. I've included this as a driver because it is a fundamental difference between my valuation of this company and what other analysts are using. The last thing I will say on this is intuitively, one would not expect a large relationship between a community bank and the US economy. The economy directly surrounding a community bank is likely the only real economic driver that will show growth to the bank. A relationship with the overall market may be present, but it would be more reasonable to find the overall correlation of regional banks to the market. Lastly, an acquisition target. In the banking sector, acquisitions are common and they're heating up. Last week, BB&T bought SunTrust Bank to form what is estimated to be the 6th largest bank in the country, with a premium paid of about 7%. As acquisitions continue in the financial sector, it is reasonable to assume a low relatively valued stock in a high growth location could easily be purchased. This purchase ideally would occur after we see the stock gains from the first two drivers. With all this in mind, a 5-year excess equity model was created with a terminal growth at 2%. The terminal multiple came out to around 13.5 for an intrinsic value of around $40. Secondly, a blended average PE multiple was used with a 13-time multiplier, resulting in about a $38 valuation. Lastly, a price to book multiple resulted in 1.36 times and an intrinsic value of 43.5. By weighting the three models 40-30-30, it is recommended that Sandy Spring Bancorp be added to the AIM equity portfolio with a price target of $40.49, representing a 23% upside as of market close yesterday. However, the stock's up about 3% this morning. Lastly, some risks associated with this stock include a lack of synergies realized with the Washington First Bancorp merger. The timeline of cost savings has already been pushed back once, and any more delays could bring the stock price down. Next, a downturn in the Washington, D.C. economy would hurt the growth of the company and its ability to collect on loans. Though this is unlikely, looking at the statistics of Washington over the past few years, it is still possible. Finally, any unforeseen regulation on the banking industry could materially affect Sandy Spring stock. Though this administration has claimed to be anti-regulation, no one knows what the president may do. Thank you all, and at this time, I'd like to open the floor for questions.
All right, questions. We'll start with Bill.
Explain to me the difference between, or what the advantage of being a community bank versus
Community bank is just kind of a little bit smaller in terms of assets. Regional and community are compared quite often. Some advantages of community would be, I guess, better, maybe a little more customer loyalty in a smaller market.
Is there any regulatory advantage?
Yeah, once you hit 50 billion in assets, some more regulations come on, such as required stress testing, and many regional banks are still under that threshold as well.
Maybe?
Based on the balance sheet, it looks like most of the loans are made up of real estate, like mortgages. Do you see it being a little bit more cyclical than other banks? Based on
Yeah, I think it's about 70% are mortgage, 25% to 25% to businesses, and 5% in personal loans. I don't see that as an issue, especially with my main driver being growth of the local economy. As mortgages go up, the bank will have much less default issues with their loans.
Andy.
How does the news that came out yesterday about Amazon canceling their New York City plans, is that going to affect you? Do you think there's a chance that political reasons could make them want to cancel their plans in the DC area as well?
That didn't worry me. I actually think it may add even more jobs into the Virginia headquarters. Virginia, the main issue with New York was the politicians not being on board with the company. Virginia passed their legislation very quickly and by a landslide. They didn't have any issue signing into legislation and working with Amazon. So no, that New York doesn't bother me. It actually kind of helps me.
Maybe we'll get it in Chicago, right?
Yeah.
I think that's what we're all hoping for. Let's talk a little bit about your net interest margin, okay? You're showing that increasing. You're forecasting it. What's the rationale behind that?
A little bit of net interest margin increase is going to be coming mostly from the synergies seen through the acquisition.
Any interest rate forecast embedded in here? Fairly flat yield curve is generally not good for a bank.
Yeah,
borrowing short. What do you got?
Yeah, I used a 5-year in the first 5 years of my calculations, and then for my terminal, I put it up to a 10-year, so a little like about a 30 basis point increase in that.
Can you talk through why you weighted them 40-30-30?
Yeah, I did 40-30-30 based on the fact that the excess equity model was the real deep dive into the company that I did, and then the peer evaluation was what I screened off of. So I wanted to show the relative valuation being low along with how I see the company moving forward.
Bill?
How does the Washington First Bank acquisition affect net interest margin?
The question was, how does the Washington First Bank acquisition affect net interest margin? That would,
Is it higher or lower than what they?
is what I,
Is the combined number higher or lower than the existing net interest margin for Sandy Spring?
In other words, acquisition, was the net margin gonna be accretive or dilutive of the bank they acquired?
the bank they acquired had a net interest margin a little bit higher than theirs, and then with it's putting into Sandy Spring along with being able to take out some loans.
With the pressure that they've been seeing in mortgage banking driving down their fee revenues, how do you see that turning around or them adapting to it to get their fee revenues back on the rise?
The question was about the fee revenues on their mortgage loans. With that, the main driver here with interest rates would be interest rates. The fee revenue obviously is going to affect them, but to be quite honest, the in an excess equity model, you're pulling in equity, and the revenues come straight from book value, or in the income comes straight from book value of equity. So I'd have to take a deeper look into that.
Eric, do you have a question? Anyone else? Oh, Ben.
Mr. Walker might have mentioned this before, but what are they doing better than a regional or other community banks in the area to actually take that 25,000 population increase growth away from other banks?
Sure. The question was how they're going to be taking the job increase and growth away from other companies and what they're doing better than banks in the area. They're a community bank. They're not going to be, you're not going to be able to see a lot of takeaway from some of the big players in the industry like JP Morgan or anyone else for that matter, of the big people. However, in community banking, the growth of the community, I'm not really, I'm anticipating more of just the general economy growing, and that being that they wouldn't necessarily have to grow customer base all that much. And then secondly to that, that acquisition of Washington First brought them into that Northern Virginia market much stronger, which is right where that headquarters is going into. So those two things.
Bill?
You do a dividend discount model?
I did not. I quickly looked at it based off of the payout ratios and my excess equity. So,
Marching up. Lockstep with earnings. The observation would have been a pretty easy one there.
Let's jump in a little ahead. What would you sell? What's your recommendation this weekend going to be?
right now, I've looked at, I'm thinking Wintrust Community Bank. We made a lot of money off of them, but they're down about 27% from their 52-week high.
Well, this stock price hasn't been all that attractive either. Kind of surprised that when was the Amazon headquarter announced?
November 18th, 2018.
Was there much of a spike or anything at that?
No, actually November saw a little bit of a decline. I have that. They missed earnings right around then. So they've actually gone down since that announcement, which is why I see that that's not factored into this.
Good. Finally, what was your screening? Were you looking for companies that were banks located where Amazon was going, or did you use something?
No, I was actually looking for just for a value stock based off of the momentum in the portfolio. When I saw them and I saw their location, it kind of hit me that would be a real good bank with a good value and a growth opportunity in the region.
Very good, man. Thank you. All right, real quick announcement. This group will be going this afternoon to Cortina Asset Management downtown. Tom Eck, who's the CIO of the company, will be here later in the semester. Next week, we'll